Mid-caps take a battering as selling resumes after yesterday's reprieve. Trump's reciprocal tariffs don't help sentiment. Healthcare industrials, they are the biggest losers.
US President Donald Trump approves the imposition of reciprocal tariffs on trade partners. He calls tariffs in India enormous and specifically points to automobiles, pharma, steel and aluminium.
India will likely increase the imports of US energy products from $15 billion in 2024 to nearly $25 billion in the near future. India's Foreign Secretary said after the Modi-Trump joint statement.
India and the US are eyeing a new 10-year defense framework that will run from 2025 to 2035. As part of the pact, the nations will increase cooperation and US will review its arms transfer rules. India's Foreign Secretary, however, clarified that there is no formal move to buy the F-35 fighter jets just yet. Hello and welcome to Halftime Report. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay and with me is Nigel D'Souza. And what we are looking at once again is a rather bleak afternoon because this has been the hallmark of trade so far this week, the mid-cap madness. It's still not ending. This is the Nifty, which is at the day's lowest point. Mid-cap index again down, taking the total losses now for the week into over 7%. Hi, Nigel.
Well, it's looking quite scary, actually, the screen as of now. But, if you're looking at the charts, Surabhi, the 22,750 to around 22,800 is very important. We try to make a double bottom out there. So, the bulls will be hoping that we can defend that mark. And even on the Nifty Bank, that 48,800 mark is from where we have bounced off numerous times in the recent past. So that's going to be important. But the pain in your portfolio is because of the broader markets. And a lot of these stocks are seeing aggressive selling pressure. Some of them, maybe the price erosion is even more than what should be the case. But it's more trading moves that we're seeing rather than fundamentals, I think. That's why some of those mid-caps are falling down. But let's focus on the January WPI data. It came in at around 2.3% or thereabouts. Lata joins us to help us out with her analysis. And we have Aditi Nair as well, who's joining in. Lata.
Well, in a rather bleak market environment, the macros are looking good. The wholesale price index at 2.31 is more benign than the CNBC-TV18 poll, which was 3%. The important part is food prices have fallen and manufacturing prices have increased a bit. Manufacturers don't like too much of fall. I mean, below 2.5% would be deflation for them and they won't like it. So actually, this is a most pleasant set of numbers as far as wholesale price index is concerned. The food basket was running at, between 8 and 13% at the wholesale level. And the number that's come today is 5.88. That is the food inflation. And within that, we still have vegetables running a little high. Year on year, vegetables are still 8.35% inflation. But month on month, they have fallen by 8.24%. So at least we are on the right track. The trouble points are still potato inflation running at 74% year on year, which means, potato, we are still paying double for potatoes. Onions is 28% higher year on year. And, generally vegetables, like I told you, up about 8.3%. But all these items, potatoes down 19% month on month and onions down 23% month on month. So at least we are on the right track, though we haven't quite reached last year's levels in terms of vegetable prices. On manufacturing, this is about the highest inflation. 2.51 is the manufactured products inflation. And that's, I think, about the highest in quite a few months, which will be a positive. Within manufacturing, base metals and some such important ones have fallen month on month, and we will come to that in just a bit. Fabricated metals is down 0.5%. Semis, mild steel is down 0.7 month on month, 0.17 month on month. Basic metals are down 0.36 month on month. So manufactured month on month fall, but year on year, it's not so bad. Aditi Nair, Chief Economist at ICRA, joins us. Aditi, this 2.3% inflation for wholesale inflation for the full month of January, does that square with what you expect? And do you see it, rising or falling from here on?
Thanks, Lata. Certainly, this number has come in a lot lower than what we had projected. Our forecast was about 3.1% in line with your poll. And what we noticed is that both the food inflation on the primary side and the core inflation are lower than what we had forecast. Now, on the food side, I think that's unequivocally good news in the sense that it is mirroring what we saw in the CPI inflation as well. And food inflation has been a big issue within our CPI. So when we get benign WPI numbers for food, at least in month-on-month terms, that is good news and it should flow through to the CPI going ahead as well. On the core side, while this month the print is lower than what we expected, I think the uncertainty globally is very high with what is going to happen to relative tariffs between one country versus another and how commodity prices are going to end up settling. There is still some concern that we may see month-on-month increases in the core index going ahead. Now, having said that, we don't think that the WPI is going to rise to unmanageable levels. Our sense is that the average WPI for FY26 will probably end up being somewhere in the range of maybe 2.7 to 3.2, 3.3%, depending on what seems to be, a band around the base case. Of course, if there is a larger hit to tariffs than what we're penciling in right now, the numbers might be a little bit higher. But as of now, the WPI doesn't look like it's going to cause too much of a concern next year.
Okay, just one final question for you. Therefore, are you lowering your CPI numbers? After all, that is what sets policy. Will you be lowering any of your CPI numbers because this WPI is lower than what the market expected?
That WPI's weight within CPI in a sense and the transmission tends to be quite modest and deferred. So as of now, we may not necessarily be shaving off the CPI. CPI is much more influenced by food in any case and also by services, which are relatively unaffected by WPI and by the rupee depreciation trends. We are looking at a 4.2% CPI inflation for FY26. Maybe, we could look at a little bit lower, but I think the uncertainty is still quite high. So 4.2 seems to be okay for now.
All right, we'll leave it at that. Thank you very much, Aditi, for giving us your quick take on the wholesale price index numbers, lower than expected. So that's a bit of a relief. But is this market going to be happy with anything at all? Actually, the currencies are not a pain point today. Across the board, Asian currencies are not showing weakness. But stock market is falling under the weight of its own expectations.
Well, that's right. Lata, I think just looking at the screen, that some part of this could be margin-led. That is, maybe in fact, some of these mid-caps or larger cap names shouldn't be falling so much. But if you have to give a margin, then you'll try to knock off something which is liquid, because in other counters, there is no exit actually. So some part of this fall, which could continue for a few trading sessions, this is the feedback that I got, is because it's more trading rather than fundamentals. Select stocks have come down to pretty decent levels, and we know this market was expensive. But I think, that is a factor at play as well, which could be one of the reasons why we're seeing so much of pain, even in relatively larger mid-cap companies. I'll tell you what, we'll slip into a short break. On the other side, we'll have Sudeep Shah, who will be joining in. He'll help us out with how he's reading this particular fall, and if he can comment on the mid-cap carnage as well. Welcome back. At least for now, the 22,800 mark is holding out. Just for now, screen wasn't looking very, very good. Trying to pull back a little bit. I think if it ranks some of these consumption-related names, HUL is a decent weight on the index. Well, that has pulled back a little bit from the lows of the day. So that's one stock that's up and about. Tata Consumer as well has been in the green for majority of the trading session. The problem is some of these other stocks, Shriram Finance, BEL, both of them at the low point of the day. Sudeep Shah joins us to help us out with how is he viewing the technical. Sudeep, I want to ask you about, in case margins are getting triggered. But first, let's focus on the Nifty. A couple of times we've gone to this vicinity of around 22,750 to around 22,800, and we're bounced off that. Today's screen is looking a little bit scary. What would your trade be? Do you think that again the bulls can defend this lower level, or do you think now we're gradually going to move into that correction zone and maybe test lower levels? First on the Nifty.
Good afternoon, Nigel. Nigel, see, markets are already on a weaker footing with all the rises being sold into mid caps, small caps, where they are literally having a torrid time since the last few weeks. But now we are seeing the large caps also witnessing incremental bearish momentum. So this 22,700, 22,800 zone in the last 4 or 5 weeks has been acting as a critical support. But now with the kind of selling pressure visible in mid caps, and with some margin calls getting triggered, and a lot of large caps also could be now becoming a casualty because of this margin trading getting triggered. So I feel that now the downfall in the Nifty could also be a bit more steeper and faster. And if 22,700 is taken out, we could see lower levels of 22,400 and 22,100 thereabouts, which 20 and this importance of this 22,000, 22,100 is that this is the 38%, 38.2% retracement of the entire up move from this 15,180 mark of June 2022 up to this all-time highs, which is closer to 26,200, 300 levels. So my sense is that this 22,000, 22,300 should be retested or could be tested, and this could act as some kind of a consolidation zone after this fall.
Okay, interesting point you make out there, that maybe some of these large caps are getting sold because of margin trading. You know, someone needs to come up with margin, and the only option they have is to sell some of the larger cap names. Got it? And 22,300 is the important mark. What about the Nifty Bank? You know, that as well has moved to around that 48,700 mark. In the past, you've seen it bounce off here. How is that looking?
Nigel, Nifty Bank in the last 3-4 days have witnessed some incremental selling pressure, and before that it was kind of outperforming. If you see the Nifty Bank and the financial services indices and compare that to Nifty on a ratio chart, that was the only sector which was left behind, or we could say that was outperforming till then. But the last few days, the kind of selling pressure that is visible there in the financial names also, I feel now 49,500, 49,700 zone will act as a resistance. Until this is not taken out, the support zones on the downside which could get retested would be 48,400 and 48,200. So although this is kind of still a bit outperforming than Nifty, the kind of fall is lesser than the Nifty names or the mid cap and the small cap indices. But yes, this too could continue its slide on the way down, which could be closer to 48,300, 48,400 levels.
Okay, so Deep, finally, just a question on mid caps, and I think this is more of guesstimates that are doing the rounds right now. What are you hearing? I mean, such a savage fall, 7-8% in a week, right? No sign of let up in stocks, just falling, double-digit falls across the board. Is it to do with some element of margin issues in the mid-cap space as well? One reason that I got was this tax loss harvesting. It simply booked the losses to offset against gains later. What are you hearing about the mid-cap fall, the reasons behind it, and any advice on what to do, any trades in this market?
See, there are a lot of reasons doing whether this tariff war or some kind of all this tax harvesting and everything. But summing up everything into one thing, my sense is now the mid caps, which had a big rally in the last 2 years, now are seeing some kind of a difficult period for the first time in the last 2-3 years. So I feel that in the coming few weeks to months, we should be very much selective while we are doing any mid cap or the small cap investing, and the first focus has to be on the large caps, because if the markets have to rebound from here, the first few months we could see some kind of a decent rally in the large caps and then in the mid caps. So while the cuts are quite steep and quite deep in a lot of names and a lot of quality mid caps if we see, but my sense is if we have to rebalance the portfolio, there has to be some higher tilt towards the large caps that offer a higher degree of safety in such an environment.
Your trades now, very quickly, quick 20 seconds. Your trades, what are you doing now?
A couple of large caps on my radar within this kind of downfall. One is Bharti Airtel. Now, if you see Bharti Airtel, that this stock has given a breakout on the weekly charts after at least 6 months, 5 months of consolidation. And we feel that 1680, 1675 here could act as a strong support, and this up move could continue up to 1800, 1830. The second name that is there on my radar is surprisingly a metal name, but that stock is doing well on the weekly as well as the monthly charts. And I feel here there has to be a positional view rather than a intraday or a couple of days view. For the next few weeks to months, I feel JSW Steel could act as a portfolio bet here. 969, 970 is the rate. We feel that 920, 930 will act as a strong support on the downside. And this stock could move steadily up to 1030, 1050 in the next couple of months.
Okay, all right. Thanks, Sudeep, for joining in. And if Trump's going to put tariffs, it could make the steel companies' case with regard to some kind of protection stronger. That could be one thought process. Thanks a lot for joining in. Time to slip into a short break. On the other side, we'll have our tax experts to analyze what's going on with regard to Trump's potential tariffs and the impact it could have on India. Stay with us.
Welcome back. You're with us on Halftime Report. Let's focus on the big global story now. U.S. President Donald Trump has approved the imposition of reciprocal tariffs on trade partners. He calls tariffs in India enormous and specifically points out to automobiles, pharma, steel and aluminum as key sectors in focus. Joining us now are tax experts. We have Mr. Sudhir Kapadia with us, as well as Anurag Sehgal, who's the Managing Director at PricewaterhouseCoopers. Thank you very much, gentlemen, for being with us. So I think the details are yet to be worked out because the deadline that's been given is up till the 1st of April, where the US does its own math and then decides how much they're going to impose on every trade partner. But just opening thoughts, Mr. Kapadia, perhaps if I could come to you first. What the president also said overnight was that this is not just about a tit-for-tat, number-to-number, tariff versus tariff. He will take into account all other costs, including VAT, for instance, and other measures through which a country is making their exports more competitive to the US. What do you think perhaps lies ahead as these negotiations carry on?
Yeah, so I think first is on the first point, as we know, that's the really calling out China, I think, more than India, because it is a stated policy of China to support their exports. And that kind of detailing, if the US has to do, I don't think they will be singling out India only, but they will be doing this for across the board, is my personal view. So anyway, that's one point. I think the larger point is this, that India has a stated policy now of really correcting the inverted duty structure issues. A start has been made in recent budgets, including the last one. In fact, the last budget also announced the formation of a committee to look at customs duty rate rationalization. The point I'm making is that inverted duty structure rationalization helps Indian industry in any ways. To the extent those products get rationalized, I think that will appeal to countries like US as well. So I don't think it's either or. A lot of the effort which India will do will also speak positively to US interests. But last but not the least, the point which you made, Surabhi, initially, the reality is we are living in a world of gated globalization. We have seen this in the context of free trade agreements as well. And I see the linkage between tariffs and free trade agreements to get stronger. I also see the inevitable situation where each country will have a certain set of differential tariffs with certain countries, and India, US will not be an exception.
So far more nuanced, very carefully negotiated trade deals. Perhaps that's what the next couple of months will bring. Let me bring in Anurag into the conversation as well. Anurag, in terms of sectors which could perhaps face the wrath or face the ire of Mr. Trump, he's already called out automobiles. I mean, he said how difficult it is to come and sell, bring cars and sell them in India. What do you think could be hardest hit? Because again, it goes against Indian policy for years. India obviously has been levying very high duty on imported cars because we want to encourage domestic manufacturing. Your views?
Yeah, I would certainly say that President Trump has been highlighting India as a high tariff place for years. In fact, in his first term also, he used these words repeatedly for India. So whether it is cars, whether it is bikes, now if you see the document also which was released in fair and reciprocal tariff, he was very clear that motorcycles, India imposes a very high duty. You would see that India may reduce duties on these products, and India has taken a start. So the recent budget on which you see that motorcycle duties has been reduced to 30%. So India has taken a start. But having said that, larger point, I think, on cars or motorcycles for that matter, is to push India to come to a negotiating table. And therein, I think that the joint press statement of the president as well as Indian Prime Minister is very, very heartening, wherein they have said that there will be a trade deal in the making. Now, the contours of trade deal will be very important because they would want something to be delivered early this year. And therein, I clearly see, at least my sense is that the trade deal would focus on certain sectors of US export interest to India and certain sectors of India's export interest to the US. And let me be very clear in this. Cars or automobiles, or for that matter, even agriculture products as a bunch, are not very high on India's export to the US. So if you talk about reciprocal tariffs, India would actually get affected if they come on pharma products, if they come on, say, diamonds, if they come on certain engineering products, if they come on, say, auto parts. So India may not get very much affected, but I think the idea was to bring India to the negotiating table, and India has been very happy in negotiating the free trade agreements past, 5-6 years. India has been negotiating with most of the developed countries. So I think India would be happy having a negotiated free trade deal with the US, is starting with a side deal. Maybe.
Sure.
So that is a place to watch.
No, absolutely, absolutely. And the joint statement says that there should be a bilateral trade agreement, a new fair bilateral trade agreement by the fall of 2025. Very quickly, a little short on time on this conversation, Mr. Kapadia, but in terms of sectors where you think maybe we'll give a little, I think motorcycles and automobiles is a very short agenda that the US president has already laid out. Anything else where we perhaps would be willing to lower duties? Which could those sectors be? Any guesses at this point?
Yeah, it's difficult to guess the sector, but I think we have to remember that in general, the customs duty structure in India today is actually pretty moderate for most of the items. As we know, the higher duties, which you alluded to, the products, etc., are what India considers luxury products. Now, from a macro point of view, the market for that is still very limited. The impact of that on India, in my view, from a macro point of view, is very limited. So giving up so-called, higher tariffs for some of these products, I think is frankly more optics, which the US may want out of a deal. But I don't think it has such a dramatic impact as far as India is concerned. As I made the point earlier, I think actually I see this as a great opportunity just to articulate that further for India. We have talked about China +1. I think a broader reduction in customs tariffs, especially as I mentioned, when it comes to the the raw materials and the intermediate products used by Indian industry, is more helpful for the Indian economy. It is more helpful for Indian industry in general. It also appeals to a lower tariff philosophy in the US today. And most importantly, will be a great competitive advantage vis-a-vis China, is how I look at it. So I think it's more opportunity than really negative.
All right, gentlemen, thank you very much for that brief take. A little short on time, but it's helpful context. Thanks for joining in. We have to take a very quick break on that note. Come back on the other side with more on the markets.
Welcome back. At least, the small mercies you have to thank for nowadays. And between 12 to around 1, we haven't seen another, a lower low. Every hour, all through the morning, you're seeing a lower low. At least for now, the 22,800 mark has held out. And the Nifty bank as well is holding on to that 48,800 or thereabouts. The breadth of the market hasn't really improved. We're still at around 270 stocks that are advancing. Towards the end of trade, what we would like to see is those lines get a little bit closer to each other. That will make portfolios feel a little bit better. And sometimes some of these margin calls, bulk of it gets done by around 12:30 odd. So hopefully bulk of that selling is already got done. Well, time to wrap up. But as we do that, as we wrap up the growth code, an initiative by Grow and CNBC-TV18. We want to help traders understand the risk of trading in illiquid options and how to manage these.
F&O trading is on the rise with market volume growing 30 times since 2018. But many traders are unaware about the risks of illiquid options.
Majority of the retail traders are jumping onto those options where liquidity is less, because that's where they can see the movement of an option price is very, very high and heavy. Now, there is a lot of problem with something like this.
Intraday price variation in the F&O segment can be anywhere between 200 to 2,000%, with record movement of even 39,900% for one illiquid stock option. With price swings so wild, these illiquid options can erode your capital in seconds.
You need to be aware that the option can become illiquid if the underlying stock prices move too far too fast. So you have to be careful about that the options are not exercised, because then a huge amount is required, else you will be penalized.
Illiquid options have also become extremely attractive for manipulators, compounding losses of unwitting retail traders.
I would say SEBI has been doing everything it takes to curb that manipulation, but it can still happen. And it's very important that retail traders should understand these kind of manipulations happen.
Periodic call auctions have been brought in to curb volatility, and SEBI is extremely active in penalizing manipulation of illiquid options, at times passing an average of 3 orders a day.
Firstly, what you have to do is check the open interest of that specific strike. Does it have enough open interest buildup? Secondly, before the event, like a result announcement, if you want to buy an option, ensure you are able to hedge the option in case of an adverse movement to the extent of 5, 10, 15% if the underlying moves.
Investing in options requires caution. Always prioritize liquidity and do your due diligence to safeguard your investments.
Welcome back, and there is no let up in the pressure on the mid-cap screen. Look at the mid-cap index. It's now down almost 3%. The Nifty is one story. The bigger story is the pain in the broader market. You can see that in the advanced decline ratio, and you can see that in individual stocks as well. If I talk about some of the losers, I mean, look at the kind of cuts. 9% gone from Swiggy. Lotus is down 10%. Deepak Nitrite came out with numbers. Yes, the numbers are a little bad. 15% suddenly gone from that stock. Natco, KFin, Manappuram Finance, 11-12%. It's a bleak afternoon. Well, that's where we'll take your leave on Halftime Report. Thank you very much for watching. We'll take the action forward. Up next is Business Lunch.